40 होता है कंटिन्यू होता है वैसा चेक पैकेट दूध भी लाने का नाम ना
गेंदे के फूल
Chapter 1, Part 1 contains bookkeeping, accounting, statement of financial position, capital, assets, liabilities, accounting equation, financial statements. Bookkeeping. Bookkeeping is a process of detailed recording of all the financial transactions in the business. Accounting uses the bookkeeping records to prepare financial statements and to prepare intervals. Statement of financial position. The owner of the business also needs to know the financial position and regular intervals. So a statement of financial position is prepared. This shows what the business owns and what is owing to it, its assets, and what the business owes its liabilities. The term financial statement is often used as a collective name for an income statement and a statement of financial position. Capital. When a person decides to start a business, will have to provide the necessary funds resources. It is often in the form of monetary funds that may consist of buildings, motors, goods, and so on. Any resources provided by the owner of the business are known as capital. These represent the amount owed by the business to the owner of the business. Assets. Once the business is formed and capital introduced, the business will own the money or other items provided by the owner. Things owned by the business or owed to the business are regarded as the resources of the business or the assets of the business. Example, machinery used in production, building used in for office, computer used for accounting work. Liabilities. In addition to the owner, other people may also provide assets to the business. The amount owed by the business to these people is known as liabilities. Example, loan taken from bank. The accounting equation. Assets is equal to capital plus liabilities. The accounting equation. Assets is equal to capital plus liabilities. Like any other mathematical equation, the two sides of equation will always be equal. The formula for this equation is assets is equal to capital plus liabilities. Capital is sometimes referred to as owner's equity. So the previous equation can also be written as assets is equal to owner's equity plus liabilities. Like any mathematical equation, the accounting equation can be used to find any one of the three elements if the other two are present. This equation illustrates that the assets of a business, the resources used by the business, always equal to the assets and liabilities. Liabilities of and capital of your business. The resources provided by the business transactions. The assets represent how the resources are used by the business, and the liabilities and capital represent where these resources come from. The statement of financial position. The accounting equation is shown in the form of a statement of financial position. This shows the three elements of accounting equation: the assets, the liabilities. Double entry system of bookkeeping. Debit is equal to credit. The ledger format of a ledger, two sides of a ledger, double entry records of assets and liabilities, double entry records for expenses and revenue, double entry records for drawings, data, balancing ledger accounts, double entry records for sales, purchases and returns, inventory accounts, goods purchased for cash or check, goods purchased on credit. Trade credit or accounts payable, goods sold on credit, cash for cash, check, goods sold on credit. Trade data or accounts receivable, purchase return, accounts sales return, return on note, good inward carriage inward, carriage outward, 3-column running balance account, format of 3-column running balance account. Double entry system of bookkeeping. A business would find it impossible to prepare a statement of financial position after every single transaction. The day-to-day transactions are recorded in the books of a business using double entry system of bookkeeping. The term double entry is used because the two effects of a transaction, a giving and a receiving, are both recorded in the ledger. Debit is always equal to credit. Debit is equal to credit. In order to record the two aspects of every transaction is entered twice on the debit side of one account and on the credit side of another account. The account which is receiving or gaining the value is debited. The account which is giving the value is credited. A ledger. The business maintains a separate ledger account for each type of asset, expense, liability, and income, and also for each individual debtor and creditor. Every transaction is recorded in the ledger account relating to a particular item or person. A ledger is traditionally a bound book where each account appears on a separate page. Over the years, the ledger has developed into a loosely ledger folder with separate sheets, each containing a ledger account. Recent developments have seen the introduction of computer file divided into separate ledger accounts. Format of ledger. This is the format of ledger. Two sides of a ledger, debit side and credit side. Ledger account is divided into two sections. Central vertical line. The left hand side is known as debit side and the right hand side is known as credit side. The term debit is usually abbreviated to DR and the credit is abbreviated to CR. On either side of the account, there are columns to record the date, details, and amount of each transaction. A folio number column is used for reference purposes. The use of folio number is not required when answering questions. Double entry records for assets and liabilities. A ledger account is open for each type of asset and liability, applying the double entry principles. Every transaction is entered twice. The account which is receiving the money is debited. The account which is giving the money is credited. Double entry records for expenses and income. A ledger account is open for each type of expense and income. The same double entry principles apply to assets and liabilities are applied to expenses and income. The account which is receiving the money is debited, and the account which is giving the money is debited. Double entry records for drawings. Whenever the owner of the business takes value from the business for their own use, this is known as drawing. This value may be in the form of money, non-current assets, or goods from the inventory held by the business. It is usual to open a drawings account to record these values so that the capital account does not have a large number of entries. Any drawings are debited in the drawings account to show the value going into that account. Then the credit entry will be in the account giving the value. When money is withdrawn, either the bank or cash will be credited. When a non-current asset is withdrawn, the appropriate non-current asset account will be created. When goods are withdrawn, the purchase account will be created. This is because these goods were originally purchased for resale and the amount of goods available for resale is reduced when goods are taken by the owner. At the end of the financial year, the total of the goods account is transferred to the capital account. This reduces the amount owed by the business to the owners. Balancing ledger accounts. At the end of each month, it is usual to balance any account of assets and liabilities which contain more than one entry. The balance is the difference between the two sides of the account and represent the amount which is left in that account. Double entry records for sales, purchases, and returns. It is necessary to open an account to record goods which are purchased for resale and also an account to record goods which are sold by the business. Double entry records for sales, purchases, and returns. While these are actually the same goods coming into the business and going out of the business, it is necessary to have a separate account where the purchases will be at cost price and the sales at selling price. And purchase account and a sales account are either used rather than goods account. The same double entry principle applies to assets and liabilities are applied to purchases, sales, and returns. Inventory. An inventory account is only used to record the goods left at the end of the financial year and not for day-to-day transactions. Goods purchased for cash or check. Whenever goods are purchased, the purchase account will be debited. The goods are coming into the business and the purchase account is receiving the return. The double entry will be credited in either the cash account or the bank account depending on whether the amount was paid in cash or check. Goods purchased on credit. It is common for business to buy on a credit and pay for the goods at a later date rather than at the time of purchase. The purchase account will be debited in the usual. Trade creditors account for the credit entry will be made in the account of the supplier of the goods to show the value coming from that person. The supplier of the goods is known as trade creditor or account payable. When a payment is made to the supplier, the bank account will be credited to show value going out of that account. And the account of the supplier will be debited to show value going into that account. Goods sold for cash or check. Whenever goods are sold, the sales account will be credited as the goods are going out of the business, and the sales account is giving out the value. The double entry will be of debit in either the cash account or the bank account, depending on whether the amount was received in cash or by check. Goods sold on credit. Just as the business may purchase goods and pay for them at a later date, it may also sell goods on credit. The sales account will be entered in the usual way. Debit entry will be made in the account of the customer, accounts receivable to whom the goods are sold to show the value going out to that person. Trade debtor or accounts receivable. The customer who bought the goods and credit is known as trade debtor. When a payment is received from the debtor, the bank or cash account will be debited to show value coming into that account, and the account of the debtor will be credited to show value going out of that account. Purchase return or return outward of goods or goods. I've done sometimes goods which have been purchased have to be returned to the supplier. This may be faulty, damaged, or not what was ordered. These goods are known as purchase returns or return outward. A special account known as purchase returns account or return outward account is opened and any returns are connected to this account to show the value being outward. The debit entry will be made in the account of the supplier to whom the goods are being returned to show the value being into that person. Sales return or return note or goods note. Similarly, a customer may return goods to the business. These goods are known as sales return or return notes. An account known as sales return account or return is opened and any returns are debited to this account to show the value coming in. The credit entry will be made in the account of the customer who returned the goods to show the value coming into that person. Double entry records for carriage invoice and carriage offers. The term carriage refers to the cost of carrying transportation goods. Carriage invoice is part of the cost of purchasing goods, which occurs when a business has to pay for goods it has purchased to be delivered to its premises. Double entry records for carriage invoice and carriage outwards. Carriage outward is a selling expense which occurs when a business pays for goods to be delivered to the customer's premises. It is important that these two expenses are treated separately in the accounts. Carriage inward, carriage outward. Goods cost, carriage is the cost of transporting goods. carriage in with the cost of bringing in the goods to the business and carriage in with the cost of delivering the goods to the customer. We call them running balance accounts. The ledger account presented so far have been in traditional form. This is also known as the T account. There is another method of presenting ledger account which is commonly used in commercial ledger accounts, which is known as three-column running balance format. The form of presentation is only one column each for the date, detail, and folio, and has three money columns side by side, one for debit, one for credit, and one for balance each transaction. The advantage of this method is that it shows the balance of that account after every transaction, and the account are prepared manually with no extra calculation to errors. Part 1. Contents: a trial balance, format of a trial balance, the particular balance, balance trial balance, error of commission, error of complete error of compensating errors. A trial balance. It is important to remember that the trial balance is not a part of the regulatory system. It is simply a list of balances. If the ledger accounts are balanced, then a trial balance may also be drawn from the term. The trial balance should be headed with the term trial balance along with the date on which it was prepared. Format of trial balance. The purpose of a trial balance. The trial balance can help in locating mathematical errors. However, the balancing of the trial balance is not good that appears in the ledger account of the trial balance is useful in preparing financial statements. Trial balance and errors. The trial balance and errors. If the trial balance fails to balance, when the trial balance fails to balance, it is obvious that an error has been made somewhere. This may be an error of addition within the trial balance, an error of addition within the ledger account, entering a different figure on the credit table entered on the debit within the double entry balance, making a same entry for a transaction rather than entering a transaction based on the same ledger. Balance trial balance. Then a balance trial balance balance. The total of the table balance it does not imply that the double entry is error. The trial balance will still have balance if any of the following errors are made. Error of commission. This occurs when a transaction is entered in the correct amount on the correct side, but in the wrong amount on the same place. Cash received from margin credit to non-customer. Error of complete bills. This occurs when the correct amount is entered in the correct account, but the entry has been made on wrong side of the cash drawing debited to cash account and credited to the balance. Error of omission. This occurs when a transaction has been completely entered in the account, either a debit entry or a credit entry. Payment of business not entered in the books. Error of origin. This occurs when incorrect the debit entry will therefore input and credit. Goods of $1,000 bought on but recorded as $1. Error of principal. This occurs when the transaction is entered into the correct amount on the correct side within the wrong plan. Motor expenses debited to the motor vehicle plan. Compensating errors. These occur when two or more accounts errors cancel out each other. Purchases account under added by dollar limit, expenses over added by recommended goods for reference. Chapter 5, Part 1 contains a petty cash book, the interest system, advantages, the layout, format. The petty cash book or interest system. Defined a petty cash book is used to record loan value for the this reduces the number of interest. The interest system. Petty cash book is used to record loan value, cash flow. The interest system of petty cash is where the amount spent each period is the escrow of so that the petty cashier starts each period with the same amount. Advantages of interest system. The interest system used to petty cash books are maintained using the interest system. Under this system, the petty cashier starts each period with a fixed amount of loan. This is known as interest amount or the during the period, payments are made out of the cash and recorded in the book. The end of the period after the petty cash is valid, the chief cashier will call the petty cash. Enough cash to restore the balance to the book. The petty cashier therefore starts his period with the same amount of cash. Under this system, the chief cashier is aware of the petty cash. This means that the petty cash is limited capital. The amount of interest system can be restored in this or not. The system cannot be restored. The layout of petty cash. The layout of petty cash. The petty cash is a ledger amount in several columns. These are known as analysis columns. The column is for each of the types of instead of folio column, the inside there is a column for a column. The number of columns are different types of format of petty cash. So you can see the format. So total amount create analysis columns. So there are various expenses columns like convenience column, So this may be convenience column. This may be like small expenses, sundry expenses. This may be like corporate student small expenses. Chapter 6, Part 1. This lesson we will discuss about invoice, trade discount, cash discount, business trade discount, checks or receipt. Invoice. When a business sells goods on trade, all contain the following: the name and address of the supplier, the name and address of the customer, the date, full details, quantities and prices of the goods supplied. Trade discount. Sometimes the supplier allows the customer trade discount. This is a reduction in the price of the goods. The rate of the discount often increases according to the quantity purchased. So encouraging customers to buy more. It is also given to businesses in the same rate. Such businesses will not be prepared to pay the full rate as they need to make a profit in this case. Cash discount versus trade discount. It is important to distinguish between cash discount and trade discount. Trade discount is shown as a reduction on the invoice. Cash discount is not shown as a reduction to an invoice, as it is only allowed if the invoice is paid within a set time. Debit note. A debit note is a document issued by a purchaser of goods and credit to request a reduction in the amount received. Credit note. A credit note is a document issued by a seller of goods and credit to notify of the reduction in the amount received. Statement of account. At the end of each month, the supplier will usually issue this customer with a statement of account. This is a summary of the transaction for the month. The style of the statement of account is very much all contain the following: the name and address of the supplier, the name and address of the customer, the date, the balance owing at the start of the period, invoices and payments, the payment received, any cash discount allowed, the balance owing at the end of the period. Checks or e-pay. Checks many accounts are paid by means of a check. Other methods of payment through the banking system are by transfers and standing orders. Check is a written order to a bank to pay as payments amount coming to the person or business. A book of reprinted checks is issued by the bank and the customer is required to complete the necessary details of the amount and pay. The person or business to whom the business is paid. The receipt. The receipt is a written acknowledgement of money received and acts as a proof of payment. So check passes through the bank system and acts as a receipt. So when a business Chapter 7 Part 1 Contents Books of Primary Trade. The Books of Primary Trade register sales journal, sales returns, purchase journal, purchase returns. Books of Primary Trade business as usual. Use books of primary record books so that use purchase sales returns and purchase returns. Books of primary also known as books of representative or subsidiary books. The name of the books are relevant because all transactions should be recorded in one of the books before they are entered in the ledger. Books of primary list. The books of primary are cash book, petty cash book, sales journal, purchase journal, sales return journal, purchase return journal, general journal. Sales journal. The sales journal is a list of the names of businesses produced sales journal. The value of the sales and dates on which sales were made. The sales journal is sometimes before the sales book or the sales journal. This journal is written up using copies of the invoices sent to the customer. The entries are summarized as follows. When goods are sold on credit, enter the date, customer name, and invoice total in the sales ledger. Debit the customer's account in the sales ledger with the invoice total. At the end of the month, credit the sales account in the normal ledger with the sales journal total. This will now form the double entry for all individual debit entries in the sales ledger. Sales returns journal. The sales returns journal is a list of name of the businesses, the value of which return, and the goods on which the sales returns were made. The sales returns journal is also known as the sales returns or returns invoice journal. This journal is written up using copies of the credit notes to the customer. The entries are summarized as follows. When goods are returned by a credit customer, enter the date, credit customer name, and sales. Credit the customer's account in the sales ledger. At the end of the month, debit the sales return account in the normal ledger with the sales return. This will now form the double entry for all individual credit entries in the sales ledger. Purchase journal. The purchase journal is a list of names of businesses by which credit purchase was made. The value of the purchase and the dates on which purchase was made. The purchase journal is also called the purchase book or the purchase journal. This journal is written up using the invoices received and suppliers. The entries are summarized as follows. Goods are purchased and paid. Enter the date, supplier, purchase rate. Credit the supplier's account in the purchases ledger with the invoice. At the end of the month, debit the purchase account in the normal ledger with the purchases. This will now form the double entry for all individual credit entries in the purchases. Purchase returns journal. The purchase returns journal is a list of names of businesses, the value of which return, and the date on which it was returned. The purchase returns journal is also known as purchase return. This journal is written up using credit notes received from suppliers. The entries are summarized as follows. When goods are returned to a customer, credit supplier, enter the date, supplier name, and the credit note total in the purchase ledger. Debit the supplier's account in the purchase ledger. At the end of the month, credit the purchase returns account in the normal ledger for purchases. This will now form the double entry for all individual entries in the purchase ledger. Chapter 8, Part 1. This lesson will discuss about an income statement, statement of financial position, financial statement, section of income statement, cost of sales, purchases, statement, profit and loss statement, income statement, also comprehensive income statement of services. An income statement. Income statement consists of two sections. The entering section in which the gross profit of the business is calculated. Outgoing section is the profit of the business system. The retaining section and the profit and loss section of the income statement are part of the double system. The statement of financial position. The statement of financial position shows the assets and liabilities of the business and its activity. The statement of financial position is not part of the double system. Financial statements. Income statement and a statement of financial position are called financial statements. Financial statements are usually divided into triangles, intermediate triangles, and expenses. One single set of financial statements. The trading section of the income statement. The trading section is considered the system of income. So, this is the gross profit. For calculating gross profit is gross profit. Cost of sales. The cost of sales represent the total cost of goods actually sold. So not necessarily the cost of goods purchased. Yes, of course, we have used install at the start of the year and some of the goods purchased. The formula for calculating cost of sales is cost of sales is equal to the purchases. The purchases to the represent the total cost of purchase. The same purchase price carries it and the paid purchases. This is the cost of goods. Cost of goods is purchases. So reducing the cost of goods available for goods taken to the owner and on formula for calculating the purchase price. Purchases. Goods trading code formula. So this is the trading code formula. So it should be presented in the subject way. The same way it should be presented in the line. This is the pattern. Formula section of the income statement. Formula section of income statement concept of profit and losses and expenses. Its purpose is to calculate the profit after all expenses and other income statement. This is another formula for calculating expenses. Profit and loss section of the income statement. This is the formula of profit and loss section. Horizontal formulas. The difference two sides. One side is the largest, or the loss, or the side is the largest. Comprehensive income statement. This is the format of comprehensive income statement. Gross profit, profit from operations, and income statement of the services, such as an accountant, expense, manager, hairdresser, and so on. As a result of the financial year, this statement of which is section of the income statement. Only the profit and loss section of the income statement and the statement of financial position. The income statement order was the statement of financial position is Chapter 9 Financial statements and contains statement of financial positions, components of financial positions, stands current assets, components of financial positions, current liabilities, statement of financial positions, statement of financial positions, the assets of the business, and the liabilities of the business, how the business goes to a certain day, such show how the resources are used and liability should be. Statement of financial position. So this is the format of statement of financial position. Assets, first current assets. Then you mention current assets. Capital liabilities. Capital. Non-current liabilities, current liabilities. Total capital and liabilities. Components of financial statement assets. Assets are divided into two types. There are non-current assets, types of non-current assets, tangible non-current assets, and tangible non-current assets. Tangible non-current assets. Tangible non-current assets are long-term assets which are often produced rather than seen. They help the business of growing its assets. Tangible non-current assets are investors and others. A statement of financial position is the non-current assets to be identified. This means the most important assets are shown. What about a short capital assets? A statement of financial position is divided into the cost and Examples of income the statement of financial position entered. Current assets. Current assets are those assets, short-term assets, because these arise from market. These are assets which are either in the form of cash or stock. Examples of current assets include financial away from cash and cash automation current liabilities. These are short-term liabilities. Current assets are Chapter 10, Part 1, Accounting Principles, Conventions and Assumptions. Contains accounting principles, business entity concept, consistency, duality, going concept, historical concept, matching principle, materiality concept, mean measurement, prudence, realization, international accounting standards, comparability, reliance, reliability, understanding, capital expenditure, revenue expenditure, capital receipt, revenue receipt, value. Accounting principles. Accounting principles are sometimes referred to as concepts and conventions. Concept is a rule which sets down how the financial activities of a business are run. The convention is an accepted method. Business entity. The business entity principle is also known as the accounting entity. The personal assets of the owner, the person is spending on do not appear in the accounting record. The accounting records relate only to the business and record the assets of the business. The liabilities of the business, the money spent with the business and so on. Everything is recorded from the viewpoint of the business. If there is transaction concerning both the business and its owner, then it is recorded in the accounting. When the owner introduces capital to the business, it is credited to the capital account. To show the funds coming to the owner, the capital account shows credit balance where the business to the owner. And the owner is drawing for the business a dividend to show the value to the owner, which reduces the amount of the business to the owner. Consistency. There are some areas of accounting where choice of method is available. For example, there are several different ways to calculate the depreciation of current assets. If the choice of method is available, the one with the most realistic outcome should be. Once a method has been selected, the method has been used consistently. This is known as the consistency. This is not done. Comparison of the financial result from here to another is possible and the cost of particular income is started. There may be a good reason why it is necessary to change the method of valuation. The change may make the purpose issue. Duality. The principle of duality is also referred to as the dual aspect. Every transaction has two aspects of giving and receiving. The term double entry is used to describe how these two aspects of transaction are recorded. Going concern. The accounting record of the business are always important. This means that it is assumed that the business will continue by any significant amount is the whole consistency. This continuity means that the non-current assets shown in a statement of will appear at their original, which is the original cost plus depreciation. Inventory will appear at the lower of cost or the original. If it is expected that the business will cease to operate in the asset following the statement of financial position, assets will be shown and their expected sales value which are more than the situation. Historic cost. The historic cost requires that all assets and activities are initially recorded. Is linked to the meaning. Cost is a known fact and can applying this principle makes it difficult to make comparisons with times. Because of the effect of inflation. Sometimes it is necessary to adopt more terms of later. Non-current assets are more realistic. So the cost of the original is the maximum principle is also referred to as the accrual fee. This is an extension of the realization principle to include the income. The revenue of accounting period is not revenue amounts to the same at the time of accumulation. The figure shown in an income statement relate to the period of the bank account. Whether or not an entity has, this means that is more relevant to comparison can be made of sales expenses and so on. Materiality principle applies to items of very low value. Items which are not worth accordingly. Other principles can be ignored if the time cost involved in the compensation value outweigh any benefit to the user. For example, a pocket calculator purchased for office is strictly an currency. Part of its value is lost each year to the office. The cost of calculating and recording this each year would amount to more than the cost of the asset. Instead of the calculator being recorded as currency, we regard it as an optional expense in the year of what is material for our business and not material for our business. Laptop computer can be regarded as material for large material for a small computer. The large business may decide that non-current assets not less than 1,000 will be regarded as material, which are small business may have a much lower value. This principle is also applied to entering smaller businesses in the general expenses and businesses rather than having for office expenses like materiality is also applied in the total cost of money maintenance principle is that only money is a it does not rely on personal life. There are many aspects of the business which are not appear in the middle of the effectiveness of good manager, the benefits of stock taking all the things that will not appear in the accounting. The value cannot appear. In a similar way, the amount of private product of increased as well as cannot be prudence. The prudence principle is also known as the principle of conservation. This principle ensures that the accounting demands present a realistic picture of the future. However, the excesses of prudence does not allow them to or the deliberate oversight. In short, prudence does not permit bias. Accountant the phrase more anticipated by the is also used to describe the principle of usually recognizing the revenue supply capital not possible loss. However, prudence is a very important. If the situation arises where applying another accounting then the principle of business applies. For example, under the realization rule, profit is earned and this actually changes. If the customer fails to pay after the principle of prudence is applied and effectively. Realization principle understands the importance of not recording profit. This means that revenue is only recorded as there has been an obligation and in order to place a customer name of change and profit is regarded as actually change. This is the same even if the goods are new or made and customer does not pay for it. International accounting. International accounting ensure that financial statements are prepared in this Knowledge of the internet is user accounting standards. The objective of the standards are to ensure that the use of financial information is effective and non-misleading. The quality of information contained in financial statements. This quality of information can be measured in terms of four factors: comparability, relevance, reliability, and accuracy. Comparability. The information contained in financial statements can be compared with similar or at any point in time. It is also useful to the ability to be able to compare the information with similar information. In order to make comparisons, it is necessary to be aware of policy. Any changes in this policy from the proof of business, it is important to be able to identify in the financial statement and the information related to other relevance. Financial statements provide information about the financial performance. This can be used as the basis for financial decisions. It is important to information not available in technology. It is also important that the information is relevant. This means that it can be used to confirm or correct and also to help farmers realizing or confirming expectations. Reliability. Information provided in financial statements is capable of formed by users of mobile financial. This is capable of being independently effective in the application prepared with suitable caution applied to services. First standard. The financial statements can be understood by the users of these models. This depends not on the clarity of the information, but it also depends on the ability of it is normally assumed that users of financial statements are and accountable. However, information should not be included in the financial statements or in the statement of two different parameters. Capital expenditure. Capital expenditure non-current expenses. Normal limit cost of current. After current non-current expenses. These costs will appear in non-current expenses. They should not be charged with this. The value of non-current assets often decreases because of this cost. Help the units. Revenue expenditure is used in the and the cost of treatment. Also include the cost of the purpose of this cost is clear in the if these two types of expenditures are correctly, this skill balance will also be technically because the machine or due to the profit for the increase, the statement and the capital capitalistic occurs when we receive the revenue from margin simply the benefit of the receipt of funds and credit or receipt of capital expenditure is investment of capital. Revenue expenditure is investment of capital. Capital receipt is mainly received by capital receipt. However, a profit or loss is revenue receipts. The revenue receipt is only received by this revenue receipt such as rent receipt. Because these arise from the normal revenue. Inventory value. Inventory value is necessary to estimate the value. Inventory has always value as a cost of inventory. This is the application of principle of more and the cost of inventory is actually The net realizable value is the basic cost of completing the organization. Usually the cost of lower happen that these are done there is no difference for the change in cost of capital. This situation the net realizable value is cost. Chapter 11, Part 1, Other Payables and Receivables. Other payables and receivables. This lesson we are going to discuss year and practical. Combined and complete balance. Here I think now very different. That is automatic. Only items related to the particular item of practical application. The practical application of that this means that the profit or loss for more simple data relating to the particular is stated in the example. Accrued expenses is an amount due in a profit during the apply this license should represent the expense for the amount and cover the this means that any amount to due but until the end of the yeah, the expense amount will now show that instead of and the balance represents yes. As it calculates any reduce Accounting for depreciation, chapter 12, part 1. Depreciation. So in this lesson we are going to learn about depreciation, the whole concepts of depreciation, methods of calculating depreciation. Straight line method, advantages and disadvantages. Reducing balance method, revaluation method of depreciation, recording depreciation in the ledger, accounting depreciation in income statements, account depreciation in position statement, depreciation in manufacturing accounts, the net book value, depreciation appears twice, disposal of non-current assets. Depreciation. Depreciation is an estimate of the loss on value of the non-current asset over its expected working life. Most of the non-current assets of the business lose value over a period of time that are used by the business. If the accounting records continue to show these assets at their cost prices, then the accounts will provide misleading information. It is therefore necessary to record an estimate of the loss in value. The records can only show an estimate of the loss in value of the non-current asset because of depreciation. The exact amount will only be known when the asset is disposed or sold. Buildings depreciate over time, but land does not usually lose value unless it is something like a well or mine when value is removed from the land. The whole concept of depreciation. The purchase of non-current asset is capital expenditure. The cost of non-current asset is not charged as expense in the year of purchase, which benefits the business for several years. Matching the capital expenditure against the sales, it has helped the business to earn is done by annual charge for depreciation. This means that the cost of non-current asset is spread over 95 years, which benefit from the use of that asset. The depreciation for the year is included in the income expenses in the income statement. So the profit for the year is not overstated. This is an application of the principle of prudence. If the profit is overstated, the owner of the business may be tempted to withdraw more cash than the business can actually afford. The principle of prudence is also applied in the statement of financial position as the non-current assets are recorded figure less than the cost. This is known as the book value or the return on value. This overrides the historic cost principle as it ensures that the non-current assets are shown as more realistic. Causes of depreciation. The four main causes of depreciation are physical deterioration, economic change, passage of time, and depreciation. This is the result of wear and tear due to the normal usage of the non-current asset. It can also be because the asset falls into poor physical state due to rust or decay. Economic reasons. The non-current asset may become inadequate as it can no longer meet the needs of the business. It can also be because the non-current asset has become obsolete as newer and more efficient assets are now. Passage of time. This arises when where a non-current asset, for example, the lease has to supply from a set number of years. Depletion. This arises in connection with non-current assets such as wells and money. The worth of the asset is taken from the asset. Methods of calculating depreciation. There are several methods used to calculate the estimated loss in value of non-current assets. Different types of non-current assets are often depreciated using it. The method selected should be the one which spreads the cost of the asset as quickly as possible over a period of time. Once a method has been selected for a particular non-current asset, it should be applied each year. This is an application of the principle of consistency. In practice, many factors are considered before a depreciation method is selected. These are how long is the asset expected to last, how much will the asset be sold for when it is without use, how can the benefits from the use of the asset be made. These are the three main reasons for depreciation: straight line method, reducing balance, and multivariate. Straight line method of depreciation is also known as fixed installment method or annual cost method. The formula used for calculating the annual depreciation using this method is cost of asset over number of years, expected years of use. This expresses the annual depreciation as an amount of money. The answer to this formula expressed as a percentage of total cost. This method applies the same amount of depreciation or the same percentage rate of the cost by each year. The value of the asset can fall to nil if there is no residual value. This method is used where each year is expected to benefit equally from the use of the asset. Advantages and disadvantages. Advantages of the straight line method of depreciation. It is relatively easy to calculate. It is useful when a non-current asset provides equal benefit for each year of its useful life. Disadvantage of straight line method of depreciation. It is necessary to estimate the useful life and the residual value of non-current asset. It ignores the actual rate at which the non-current asset will lose value. Reducing balance method. Reducing balance method of depreciation is the name implies the amount of depreciation reduces each year. The same percentage rate is applied, but is calculated on a different value each year. At the end of the first year, the depreciation for that year is calculated on the cost of the asset. The depreciation of the following year is calculated on the cost of the asset. Thus, the depreciation previously written on the figure of cost. The figure of cost plus depreciation is known as the net book value or return on value of the asset. The value of the asset can never fail or to be done. The depreciation allowed calculated as a percentage of net book value. This method is used when the greater benefit from the use of assets will be gained in the earlier years of life. Assets depreciated by this method often have low maintenance costs in the year of early years. This method is often used for those assets which quickly become out of date because of advanced technological progress. Any residual value is taken into consideration and the percentage rate is selected. Advantages and disadvantages. Advantages of the reducing balance method of depreciation. Matches cost with revenue. It is useful for those non-current assets where greater benefits are gained in the early years of life. Disadvantages of the reducing balance method of depreciation. The depreciation has to be recalculated each year. The depreciation charge against profit is greater in the early years of non-current assets. Revaluation method of depreciation. This method is used where it is not practical or it is difficult to keep detailed records of different types of non-current assets. If detailed records are not available, then the stricter method revision or method of depreciation cannot be applied. Small items of equipment used in offices and laboratories, packing cases, loose tools, etc. are usually depreciated using revaluation method, as no detailed records are kept for these assets. The assets are valued at the end of the each financial year. This value is compared with their value at the end of previous financial year or with the cost of execution if it is the first year of ownership. The amount by which the value of the asset has fallen is the depreciation for the advantages and disadvantages. Advantages of the revaluation method of depreciation. It is not necessary to estimate the useful life and residual value of the current asset. No complex calculations are required. Disadvantages of revaluation method of depreciation. The non-current asset has to be revalued at the end of each year. The valuation is based on personal opinion. Recording depreciation in the ledger. Recording depreciation using the statement method and reducing balance method. The procedure for entering depreciation calculated using statement method and reducing balance method is easier. Each year of non-current asset has two ledger accounts and account for recording the cost of the depreciation, account for recording the depreciation, the provision for depreciation of asset. The asset account always has a debit balance and the provision for depreciation always has a credit balance. These two balances must always be considered together. The difference between the balances of these accounts represents the net book value of the asset. Recording depreciation in the financial statements. Recording depreciation in the income statement. The depreciation for the year for which each type of asset is credited to provision for depreciation and is debited to the income statement. This reduces the business profit for the year. As depreciation is non-monetary expense, it is usually shown after the monetary expenses in the income statement. Depreciation in manufacturing business. So the business is a manufacturing business. Depreciation of this is in manufacturing process is debited to manufacturing rather than manufacturing. This increases the cost of manufacturing, which in turn reduces the profit for the reducing recording depreciation in the statement of financial position. It is usual to show the total cost of each type of non-current asset like the total depreciation return now to the date of statement of financial position, referred to as accumulated depreciation or depreciation. The difference between these figures is the net book value. Depreciation appears twice. The financial statements are prepared from a trial balance and its accompanying notes. In the trial balance, the balances on assets are shown on the debit column and the balances are shown in the credit column. One of the notes will indicate the depreciation of the child financial year. The depreciation for the year will appear twice in the financial statement. It is an expense in the income statement and it is included in the statement of financial position or part of the provision for depreciation. The depreciation for the year is added to the balance sheet in the trial balance. Disposal of non-current asset. Because the purchase of non-current asset is capital expenditure, it is recorded in an account for the current asset rather than in purchase account. When a non-current asset is sold, it is capital asset and is recorded in special account known as disposal of non-current asset account rather than in the sales account. When a non-current asset is sold or disposed, it must be removed from the ledger. The cost of the asset and the depreciation of the asset are removed from the asset account and the provision for depreciation account transferred to the business. The process of sale are also entered in this account. It is quite likely this account will not balance. This is because the depreciation was only an estimate and the cost. of the loss in value. Only when the asset is sold can the actual loss in value be computed. The difference on the disposal account represents whether the loss on disposal and the actual depreciation proved to be more than the estimate, or a profit in disposal when the actual depreciation proved to be less than the estimate. Chapter 13, Part 1, Irrecoverable Debts and Provision. In this chapter, we discuss irrecoverable debts, writing off, irrecoverable assets, written off, irrecoverable debts, provision for irrecoverable debts, estimation, creating, adjusting a provision for irrecoverable debts. Irrecoverable debt. If goods are sold on credit, the customer is allowed to pay for the goods at the level. It is always it is the customer will not pay for those goods. And irrecoverable debt is an amount owed credit, not be paid to the customer. This may be because the customer has disappeared or gone out of business, or because he is if all reasonable steps to obtain payment are taken, the debt is due. The account of customer is closed, the transfer in the amount to the at the end of the year, the total of the irrecoverable debts amount is transferred to the institution, where it is regarded as a writing off. Writing off irrecoverable debts is an example of the application of the principle of loss. If the debt cannot be regarded as an asset, it is written off, so that the assets are not lost. The amount of the irrecoverable debt is regarded as a loss for the year, so must be included in the income statement. Otherwise, the profit for the year is lost. Recovery debts written off. The debt written off may be recovered if the customer pays some or all of those after that. As the account of the customer has been closed, the amount received is debited in the cash and credited to a debts recovered account. An alternative method is to reinstate the debt by creating the debts recovered account and debiting the customer with the amount to the amount received would then be entered in by debiting the cash and crediting the customer. The advantage of this method is that all the transactions relating to the customer appear in the year-end adjustment. At the end of the year, the total of the debts recovered account can either be transferred to the income statement as income for the year or transferred to the credit of the irrecoverable debts account, where it is the reason of the debts during the year. Reducing the possibility of irrecoverable debts. The only certain way of avoiding irrecoverable debts is not to sell goods on credit. In practice, this is not always an option. All possible steps may be taken to avoid irrecoverable debts. Before allowing credit to any customer, credit preferences should be inform a customer's bank and present use. A credit limit is usually fixed for each customer. This is an upper limit of this credit limit can be reviewed periodically. The establishment of credit limit and the later management of the customers. Invoices and maintenance statements account should be issued promptly. The sales ledger account any overdue account should be investigated and customers contacted below emails and credit costs. No further goods should be supplied until the amount due is paid. The more extreme measure involves taking legal action against the sometimes the amount of debt is too small to justify costly legal fees. Provision for doubtful debts. So provision for doubtful debts is an estimate of the amount of the business will lose at the end of the financial year. Business is credit and estimate the amount which will be lost because of the credit. This ensures that the profit for the year is not overstated of the at a realistic level. This is an application of the principle of debt. By maintaining a provision for doubtful debts, the business also observes the principle of debt. The amount of sales for the business is unlikely to be paid regarding the expense of the year. Those sales are made rather than the expense of the year, any debt is actually estimation. In order to make the provision for doubtful debts, it is necessary to estimate the amount of doubtful debts. The amount of provision is established by looking at the individual credit customers account, estimating which one will not be. Estimating on the basis of past experience the percentage of total amount. Considering the length of time that's having outstanding means of an aging schedule. The provision of a higher percentage may be made on older than the longer the debt is, the greater the risk. Creating a provision for doubtful debts. Once it is decided to create a provision for doubtful debts and the amount of percentage has been decided, this can be recorded in the books. These entries are made at the end of the financial year. The entries are summarized as follows. Debit the income statement statement provision for the statement of financial position deduct the balances of the provision account for the trade receipts. Adjusting a provision for the future years, it may be decided to maintain the provision using the same facility. If the amount owing has increased, the provision need to increase on this year. So if the provision, original provision for the debt was based on the amount of money that was necessary to decide in this change. This adjustment for the provision of debt is made at the end of the financial year. The entries are sometimes as follows. Debit the provision for debt along with the new provision and carry down into the transfer the difference in the provision to the in the statement of financial position, debit the balance of provision for debt account, the new provision to creditors. Chapter 15, Part 1, all journal entries. This chapter we discuss about the transactions, correction of balance errors, effect the current balance, suspense account entries, error of effect of errors on financial statements. The journal of practically used to record transactions, not to recording. The journal is not part of the not in the variance both the not entered into the procedure. After one say this things are made, stars are and open journal entry with the assessment of the documentation and the capital documentation of the journal purchase and sale of non-current assets. The purchase and sale of non-current assets are not recorded. They should be entered in the document before the after the transaction is placed to the document. Non-regular transactions, as explained earlier, any transaction which is not recorded. These often consist of transactions which are not occurring for regularly and here transfers transaction is placed to the appropriate document. Correction of errors. Errors in the recording of data transactions can be errors which are not shown to the transaction. There are 10 types of errors, 6 types of errors which can be made. Error of principal component. Such errors are discovered using this. Error is effective one. Sometimes connected to the the errors are not this is regarded as a temporal data. The suspense account. The suspense account ensures the balance of balance and non-drop functions. It also allows us to raise the regulatory and ensure that all errors are clearly settled. The errors are not identified. The appropriate entries are and all the errors will be corrected. Balance is all the errors of the applicant. Any correction in items appearing in the transaction corrections. Effect on statement of function. If errors are discovered in corrected application, other items not significant. Chapter 16, Part 1, Control Accounts. Control accounts. In this chapter, we will discuss all about control accounts. Content contents of control accounts, sources of preparing control accounts, items included and excluded in control balances. Control accounts. Control accounts are also known as total accounts. The trial balance shows the balance of the event cannot be business check not by account. This can take a considerable amount of time. The checking process can be speeded up if the control account process which contain the account within the task the control account or the purchase items which contain the account within the task of the These accounts act as a check on the integral account between these ledgers. Like the trial balance, however, these accounts can check the arithmetical accuracy. Errors such as omission, correction. Sales ledger control account. The sales ledger control account is an account including all the accounts. Purchase ledger control account. Purchase ledger control account is an account including all the accounts of the advantage in accounting. There is full set of accounting records. The advantage of preparing these accounts are you can assist the budgeting they are good the arithmetical accuracy, ledgers the balances on these accounts are divided by receivers and the total of the trade payments. So this information is available. Draft financial statements can be prepared with different balances for they have to reduce fraud and the control accounts are prepared the same. Not may involve in business purposes. They provide a summary of the transactions and the trade receivers and the trade payments. Excluded account. This is because the account is a summary of the account of trade customers. Not included such as cash sales and sales ledger control account. Sales ledger control account. This is also referred to as this account reveals the amount of but instead of containing transaction, contains transaction to all the debtors. The typical sales ledger control account is sales ledger control account. So on the debit side, you can see the balance is here, sales, and purchase items, discharge. So on the credit side, sales items, cash, discount allowed. This account acts as which account here the sales source of sales receive from credit customer discount differential payments irregular tax interest on ledger control account is one of the the total of the balance is on it indicates that there is an error in the customer. Purchase ledger control. But instead of containing transactions, consider typical purchase schedule ledger control account. So this is the format of purchase. So you can see purchase returns on the debit side, cash, bank, on the credit side is balance for the purchase, this as so the accounts are similar to the purchase check on the this is of purchases are often from the they will be doing support this charge of this is the total of the balance if they differ it will be What is not used? The accounting is sales and purchase ledger are not used for credit. What is included? Sales ledger account is customers pay business, so not included. Such as cash and so purchase ledger account is summary of the account of the suppliers to so not included. Balances on books. There should be a great customers account. But more to the customer you can use after the customer. For them. The sales that the company give it great balances of the account for active balance. And the more active balance is balances on the similar group suppose account but this method is more to the supplementary as in the sales ledger control account, the debit balance and the first credit balances are shown separately in the purchase ledger control account. The purchase ledger control account will therefore have two balances. Credit supplies and non-user debit balance. By credit supplies, any balance, debit balance is included on the credit side of the control account and carried down account. Contra entries in control account. Contra entries are also known as the transfers or set off. It may happen that a business sales goes to another business and also by different goes from the business. This means that there will be two ledger accounts for the business. One is the sales ledger and another is the purchase ledger. Rather than each business sending the other a check to the cover the amount, then agree to set one account amount is the other. Any remaining amount will be settled by one business issue. Transfers and set-offs. Contra entries may refer to transfers and set-offs and when transfer is from an account is associated with an account of the same business or person. Chapter 17, Complete Records. In this chapter we discuss incomplete records, advantages of the records, statement of business, not accounting of it, cash discount, complete records, markup, margin, and rate of return. Incomplete records. Sometimes businesses, small businesses in particular, do not take the detractors. Different calculations depends on the records of set of financial statements can be advantages of maintaining the records. Maintaining a full set of documentary record is important part of the problem. Full details allow the balance. The preparation of financial statements. The calculation of the profit or loss is related to the balance. More informed decision making is possible. Greater degree of control over the possibility of fraud is reduced. Comparisons with the results of previous year and results are possible. Detailed records are available for reference purposes. Information required the bank or other than statement of interest. The only records available are those related to the assets and liabilities, not possible to prepare. These assets and liabilities are displayed in the statement of interest. In a list of assets and liabilities, the statement of affairs rather than the statement of liabilities. Formula: the assets, liabilities, and capital of business are known, and no other information is the only way to profit can be measured is to compare capital. Capital increases when a profit is made and decreases when a loss. This is formula for capital profit is closing capital and opening capital. What are the differences between the two capital figures called the drawing? The additional capital. The additional capital has been introduced. It will also about the additional capital. Closing capital and opening capital. Cash discount. Cash discount allowed at the calculation of gains the discounts is recorded in the profit and loss section. Markup margin and dealing with pen market because it is sometimes markup and these both figures these both measure the gross profit as a percentage. The markup is the gross profit measured as a percentage of the profit. Margin is the gross profit measured as a percentage of the profit. Rate of inventory turn. It is sometimes necessary to use calculations related to turnover in order to calculate the rate of inventory turnover is the number of times. The formula for calculating the rate of inventory turnover, cost of sales. Chapter 18, Part 1, Accounts of Clubs and Societies. In this chapter, we discuss NPO, non-profit organizations, receipts and payments, nature of surplus account, income and expenditure account, accumulated funds, subscriptions, not-for-profit organizations. This chapter concentrates on the accounts of non-trading organizations such as clubs and societies. The main aim of these organizations is to provide some facilities and services for their members. Making a profit is not the main objective. Examples of such organizations include youth clubs, sport clubs, amateur dramatic groups, golf clubs, scouts, etc. In some cases, a full set of double entry records will be written on each year, but it is more easier to find the monthly record of money issued and paid. Main source of income of society is subscription. These are the amounts members pay, usually annually, to use the facilities provided by the club or society. A person is appointed to act as treasurer and be responsible for collecting any money and making money by the society. At the end of the financial year, the treasurer will usually present financial statements to the members. These financial statements may consist of receipts and revenues, possibly a trading account section of an income statement and income account, and a statement of financial position. Preparation of a receipts and payments. A receipts and payments account is regarded as summary of the transaction. All money received is debited on the credit. The account is balance and balance carried out to become the financial. The account does not usually distinguish between cash and bank transactions. So the balance may represent actual cash, money in the bank or combination of both. A debit balance is an asset and represents money owned by the society, whereas a credit balance is a liability and represents a receipt and payment account, just like a cash book, records all money received and paid. It is important to remember that no adjustments are made for accruals and payments. No distinction is made between capital receipts and revenues. No distinction is made between capital expenditure and revenue. Non-monetary items such as depreciation are not. A real account. The receipts and payments account includes all money paid and received, including the year to which it relates, and includes both capital and revenue items. Preparation of income statement of a club or society. Although buying and selling is not the main purpose of club or society, many do carry out a trading activity. Many clubs operate a shop or a cafe where they sell small and small. At the end of the financial year, income statement trading section to show the profit earned on that activity. The trading section of an income statement of a club or society is prepared in exactly the same as the any expenses which arise as a result of the trading activities such as wages and cafe assistance, depreciation of cafe equipment and so on, should be added to the cost of the goods sold in order to calculate the correct profit. Surplus of deficit. An income and expenditure account is prepared annually by a non-trading organization. Compares the gains and expenses to calculate the surplus account. Surplus arises when the gains of a non-trading organization exceed the expenses. The difference arises when the expenses of non-trading organization exceed the gains. Preparation of an income and expenditure account. An income and expenditure account compares the gains of the club with the expenses of the club. If the gains are more than the expenses, the difference is referred to as the difference of the excess of income. This is known as the profit for the area. If the gains are less than the expenses, the difference is referred to as the excess of expenditure over. This is known as the loss for the area. An income and expenditure account is prepared using the same principle as those of the It is important to remember that taxes capital receipts and capital expenditure also are not included. Only revenue receipts and revenue expenditure are included. Non-monetary items such as depreciation assets and liabilities of the company and their financial. When the where the club or society holds a fundraising activity, the income and expenses of the society accumulated fund. Accumulated fund consists of the surplus plus any deficits which have accumulated in the organization. It replaces capital in the statement of financial position of the club or society. Preparation of a statement of financial position of the club or society. The principles applied in preparing a statement of financial position of the club or society are similar to the statement of financial position of the club or society shows current assets, current liabilities, current liabilities, exactly the same way as the statement of financial position. Drilling operation. The main difference is that there is no capital investment in the financial position, whereas a business is really financed by additional of capital. Members of a club or society do not invest money in the same way as the members. Because of this, the members are not entitled to make any transaction in the club or society. This means that this surplus will be accumulated in the capital, known as the accumulated fund. If the club makes a deficit, then the accumulated fund will decrease. This accumulated fund replaces capital in the statement of financial position of the club or society. Subscription. Subscription owned by the members are a debit balance on the subscription account asset in the and a current account asset in the statement of financial position. Subscription is prepared by members or credit balance on the subscription bond and credit balance and a current liability in the statement of financial position. Subscriptions in receipts and payments account and income. The receipts and payments account shows the amount of subscription received in the financial. This means that the amount received is registered for the subscriptions, both by the members and the subscriptions period for month. The calculation of the amount relating to the financial condition is found as subscription. This may be regarded as the account of the subscriptions owing by members will appear as a debit balance as they are a current asset to the club or society. Subscriptions paid in advance by members will appear as a credit balance as their current liability because the club or society has an obligation to provide the members, which has already been paid. It is also possible to have balances, to have two balances on the subscription account as the account is all for all the members and some may have paid and subscriptions in advance and some may have not paid. Yes. At the end of the financial year, the account is closed by transfer to the income and expenditure account of the amount related to the financial year. Subscriptions return off. A club may have a policy that subscription is paid after a certain period of time or return. The entries are made similar to those in a business rate of equal. The subscription account is credited with the amount received before the subscription. These irregular payments are included in the calculation of sales and budget. As the accounts of clubs or societies are often incomplete, it is often necessary to calculate credit processes and sometimes credit sales also. Before the preparation of income statement, the same principles apply and calculating these figures for the complete set of accounting records are followed. Calculation of it is sometimes necessary to calculate the accumulated fund of the club or society. This can be calculated by applying the same formula as capital in the club or society assets will be contributed to these liabilities. Chapter 19, Part 1, Partnership Fundamentals. This chapter will discuss partnership advantages and disadvantages of partnership agreement, content of partnership, interest on capital drawings and loan, partners capital account and current account, capital account versus current account. Partnership. The earlier chapters another very common partnership. A partnership is a business which is two or more people. They cannot be partners. Professional people such as accountants and solicitors often operate as partnerships. A large number of family businesses also run as partnerships. Sometimes a new business is founded as a partnership. Sometimes a partnership is founded